Welcome to this Masterclass Explainer. Look, if you're targeting that A star in IGCSE Accounting 0452, you are in the exact right place. Today, we're completely tearing down business documents as source material. Now, to give you the ultimate edge, I'm actually going to be playing two very distinct roles today. First, your subject specialist, breaking down the complex multi-layered theory, and second, your senior examiner, showing you exactly where candidates just throw away easy marks under pressure. We're not just talking about some simple data entry exercise here. We're building the fundamental bridge between raw business transactions and high-level financial intelligence. So let's get right to work. Right, here is our roadmap for today. We're covering the core architectural foundation, step-by-step technical execution, AO3 interpretation and ratios, examiner warnings, and fintechs, and finally, the final A-star challenge. Okay, let's start with Section 1, the core architectural foundation. So, for the syllabus 2028 to 2030 updates, using modern international terminology is absolutely non-negotiable. Old terms, completely out. Irrecoverable debts and owner's equity are strictly in. Think of the fundamental accounting equation, assets equals liabilities plus equity. It's basically like the foundational structural beams of a massive skyscraper. If one side bears way too much weight without a perfect counterbalance on the other, the whole building literally collapses. You've got to confidently apply the business entity concept to maintain this perfect duality in every single transaction. Whether it's a huge capital injection or just a minor cash expense, that structural integrity absolutely cannot be compromised. Let's go ahead and put on the subject specialist hat for a moment. The prudence concept is your ultimate reality check in accounting. It dictates that you must record potential losses immediately to make sure profits are never artificially inflated, whilst only ever recording profits when they're actually realized. And trust me, you will absolutely be tested on strict vocabulary here. Take accrued and prepaid expenses, for instance. An accrued expense means you've consumed a service but just haven't paid for it yet, right? You owe that money, and prudence demands you record that liability right now. A prepayment means you've paid in advance for a benefit you haven't fully received. You've got to intimately understand these definitions and immediately apply them to the multi-layered business scenarios you'll see in your coursework and your exams. Let me ask you this. Are you overstating profits by ignoring potential losses? Because doing so is a fast track to absolute financial ruin. Think about the stakeholders involved here. Banks extending credit lines, owners reinvesting their capital, tax authorities demanding their cut. They all rely entirely on the absolute integrity of your financial records for their critical annual decision-making. If you ignore a potential loss, you're artificially inflating the success of the business. You are essentially lying to the market. And in the real world, that destroys businesses and completely shatters market confidence. Moving on to Section 2, step-by-step technical execution. This is where we lock down your methodology. Let's walk through a complex, multi-step problem to see this procedural cause-effect chain in action. Imagine a customer buys goods from you on credit for $500, subject to a trade discount. Well, first, you identify the foundational document, a sales invoice. That specific document acts as the absolute source for the sales journal, your book of prime entry. From there, the data flows directly into the T accounts, where you debit the specific customer's account in the sales ledger and credit the main sales account in the general ledger. This is the double entry system executing flawlessly. Finally, the whole thing has to balance perfectly in the trial balance phase. Just one misstep or one flipped entry, and the entire chain breaks down before you even reach the final financial statements. Okay, senior examiner hat securely on now. Students absolutely hemorrhage marks here year after year, and it drives us crazy. You have to master the precise art of balancing these accounts. So here is a really great high-level memory hack for when you're under exam pressure. Think of balance B/D as beginning data for the new month, and balance C/D as closing down the current month. Beginning data goes on the opposite side, closing down goes on the same side to balance it out. Simple, right? Furthermore, a massive mathematical pitfall is miscalculating percentages when you're trying to distinguish between trade discounts and cash discounts. Remember, trade discounts happen at the point of sale and don't appear in the double entry. Cash discounts happen at the point of payment and absolutely do. Memorize that distinction. Let's talk about the method mark strategy, because it is your absolute safety net. In both your coursework and the final exams, marks are actually awarded for your procedural logic, even if your final calculation completely fails. But you must document your evidence meticulously. Look, if you're calculating a complex depreciation adjustment, please do not just write down a final number. Show the core formula, show the clear substitution of the numbers, and then state the result. Make your entire thought process visible on that page. If you make a tiny arithmetic error in step 1, but you carry that flawed number through the correct procedural logic in steps 2 and 3, a senior examiner will still award you those subsequent method marks. Seriously, show your workings. Section 3, AO3 Interpretation and Ratios. This is exactly where you cross the line from a standard student just calculating baseline skills to an A-star candidate offering high-level evaluation. Imagine the sheer panic of seeing a business's current ratio plummet from a really healthy 2.5 to 1 down to a highly alarming 1.1 to 1. Now, calculating that ratio is merely the baseline requirement. The real question is, why is 1.1 to 1 alarming? Because it means the business barely has enough liquid assets to cover its immediate short-term liabilities. If current liabilities are called in tomorrow, the business is hovering dangerously close to a severe liquidity crisis. Identifying what that ratio actually means for day-to-day survival, that is the real test of your financial intelligence. And this is AO3 Practical Skill in Action. You are essentially stepping into the role of a financial detective here. You've got to ask the high-level investigative questions to diagnose exactly why this happened. Is the business suffering from overpurchased, obsolete inventory just sitting unsold in a warehouse somewhere? Are trade receivables taking 90 days to pay instead of 30? Or perhaps cash reserves have been severely depleted due to a massive, poorly timed capital expenditure. Your job is to interpret the raw data, isolate the root cause, and provide these deep analytical insights. Also, when you're making inter-firm comparisons, keep in mind that differing accounting policies are a massive trap. Comparing a business using the straight line method of depreciation to a competitor using the reducing balance method, it's literally like comparing a marathon runner to a 100-meter sprinter at the 1-mile mark. They are running completely different races under completely different parameters. The reducing balance method hits early profits really hard, while straight line spreads it evenly, so you can't just compare the surface profit numbers blindly. You have to intellectually adjust your evaluation to account for these differing underlying methodologies. Let's jump into Section 4, Examiner Warnings and FinTech. It is time to bridge strict exam requirements with modern industry reality. The senior examiner reports from recent cycles basically scream this warning from the rooftops. And the crazy part is, it's something you have complete control over. First, students frequently lose easy marks simply through poor, illegible handwriting in ledger accounts. If I, as the examiner, cannot read your logical flow, I cannot award those critical method marks we just talked about. Second, a major pitfall is the failure to distinguish between revenue and capital items. When you're under immense exam pressure, just use this strict mental rule. Revenue expenditure is for running the business today, like paying rent or fixing a broken window. Capital expenditure is for creating capacity for tomorrow, like buying a brand new delivery van. Keep them strictly separated. Switching back to the subject specialist, how does all this theory actually translate into industry practice? Well, modern fintech applications, like AI-driven accounting software, such as Xero, are completely revolutionizing how source documents are handled today. The software intelligently automates the transition from raw document to prime entry. And why does this matter to you? Because AI software doesn't have bad handwriting, and it rarely accidentally swaps a long-term capital expense for short-term revenue one. Understanding this real-world automation shows you exactly why mastering the manual core architecture is so vital. You are literally learning the underlying logic that powers multi-billion-dollar financial technologies. Finally, Section 5, the final A-star challenge. We're going to push our analysis beyond the financial ledgers entirely. To truly secure that A-star, you've got to lift your head out of the ledgers and adopt an executive mindset. Long-term sustainability and your return on capital employed, or ROCE, rely heavily on qualitative, non-financial factors. Elements like internal staff morale, the physical, geographic location of the business, and its overall brand reputation in the market are absolutely vital. These elements are not neatly captured in your standard double-entry accounting records, yet they completely and utterly dictate the future financial success or absolute failure of the business entity. I'll leave you with this pause and think challenge. If you perfectly synthesize all the financial ratios we've discussed today with these qualitative, non-financial factors, how would you actually evaluate the true quality of a business's profit? I mean, is a high net profit margin truly sustainable if your staff morale is at rock bottom, your product quality is slipping, and your market reputation is completely tanking? You have to look beyond the surface numbers to find the real story. That deep investigative mindset is exactly what secures the top grade. Keep your methodology sharp, keep pushing your analysis, and use these examiner insights to your absolute advantage.